Awesome. Welcome to Be the Market Expert. And I want to kick it off with this. And this isn't something that I truly, lean on when we're doing this course, but I think that, or this class, but I think that with so much going on and being the market expert, I think it's not only knowing what's happening in as far as like real estate sales goes and inventory and mortgage rates, but I think we also have to, keep in mind some of these things with commission as well. And it's interesting because I think that like if we were to look at Colorado contracts, we have to keep in mind that like in Colorado, we have taken less of a beating than most states have. And it's really because of how our agreements are laid out. And it's also probably putting some more pressure on how we're going to do business down the road, just because Marsha Waters came out and said like, hey, no, this is not for the consumer. This is against consumer protection, and that's all that we're here for in Colorado is to protect the consumer, which is what saved us for so much. But now like we're running into some interesting things, and I think we're still good. But this popped up today, and it says commission sharing websites have emerged, but it's buyer beware. And it's interesting because I think this is not, it's kind of a misleading title. And the buyer beware piece, I think they're talking to us, the agent, as the buyer. Like it's not the consumer as the buyer. And as we look at this thing, it says the August 17th deadline's looming. And for everyone on this call, right? So August 15th is when all of our stuff's going to go live, right? RE Colorado is going to kill off the commission piece that's inside of the MLS. And so the 15th, that's going to disappear. If you have a listing, don't worry about it. It's just going to automatically happen. And the 17th is the settlement date. And so that's like the go live, do not pass go, do not collect $200. Like this is where we are. But if we look down here, it's interesting. And so I'm going to quote this person who's, a KWOP. And it says, when the terms of the NAR settlement came out and there was the piece about compensation in the MLS, I had been in a meeting with some of my top listing agents who have had sometimes up to 50 listings discussing how they are going to handle this. The operating principle for KW Du Bois. And it says, all of a sudden, they're going to be getting calls, text, emails, and if their seller is willing to offer compensation on top of all the other communication. And we know that we had an efficient way of handling this sort of communication. All right. So this is a conversation that we've been, just thinking about, right? Like, firstly, if you were on the call, what, a week ago, 2 weeks ago, I said that listing agents are the worst with answering their phone to begin with. And I think that's very true. But what we're seeing right now is real estate agents are popping up and they're saying, oh my God, but the workload, right? They're like, how am I going to be able to answer all these calls? And how am I going to be able to get all the text messages and whatever? And I think this is what we need to keep in mind. What has happened here with NAR, the DOJ, the commission lawsuit, all this stuff, this class action, it's not to protect us. It's not to make our lives easier. It's not to help us. They do not care. All right. And this is a conversation that Margaret and I were having the other day because we were actually talking about the brokerage disclosure to buyer. And we were just having this conversation on our drive down from Evergreen the other day. And we both came to the conclusion that nothing in place is to make our lives easier. And nobody cares if our lives have gotten harder because of all this. This is to protect the consumer. They said, like, we have misled the consumer as an industry. Well, I don't believe that we have. I think a lot of people don't believe that we have, but a jury of our peers have said, yes, you have. And that's why we're in this road. So all this came through, and they were like, well, our lives are about to get really, really busy here. And we look through here, and I'm just going to scroll down. We'll scroll down, and it says this for third parties creating these sites, because what they're doing now is they're going through and these sites are popping up. They're like, okay, guys, well, the rules say that you can't offer compensation on the MLS. And that's really what the rules are. Like the rules say you can't offer compensation on the MLS. It doesn't say you can't email it out. It doesn't say you can't blast it on Facebook. It doesn't say you can't put it on carrier pigeon, whatever. Like it doesn't say any of that. It says no compensation on the MLS. But the DOJ has already said, like, guys, don't be cute about this, because while the class action's gone through, we're reserving the right to reopen this case whenever we want to. And what has happened with all this stuff's going on is someone came through and said, I see an opportunity here. I see an opportunity to come through and open up a website that will actually talk about compensation, where all the real estate agents can come and they can find compensation. They don't have to pick up the phone. And not only not pick up the phone, but the listing agent doesn't also have to be fielding phone calls all day long. Well, I think this pulls it out. It says, for the third parties creating these sites, we don't think there's an expressed rule against them doing this within their terms of the NAR settlement, right? So it's saying, like, there's no rules in place to say that these sites can't pop up. They said, but the people who are providing the information to them, they might be violating the terms of the settlement. All right. So this is saying that there's no rules against these websites existing. But if you participate in these websites and you're actually inputting information, you actually might not be protected by the settlement anymore. And I think that's what's very, very important about this. And like, of all these conversations that we're having, is that the issue is, if we do something that violates the settlements that we are protected by, we are no longer protected. And I say we, I use the term loosely, this we part. Whatever agent participates is no longer protected. This isn't a, well, the whole brokerage, the whole industry is going to go down. Unless the brokerage isn't having conversations around it, I actually think that the agent's going to go down, and your E&O doesn't protect you at this point. So I just want you guys to be aware of this as this kind of stuff is popping up, even these Facebook groups, all this craziness. So this is going to happen more and more. There's going to be agents looking to get around this. You see a lot of these cute Facebook posts that are popping up where they're like, this is what I'm going to write to make sure that people know that we're buyer agent friendly on my listings and da 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 whatever. Guys, we're just going to have to figure out the new way of doing business. And really what it's going to be is it's going to be listed and negotiate it into the contract. Like, that's all we're going to do. Check the checkbox that gives you permission to enter into the contract, and then negotiate it out in the contract, and everything's going to be good from there. And again, like, yes, there's going to be a little bit more friction as we're having to pick up the phone. Yes, I'm offering compensation. Thank you. Have a great day. Like, that's what this is going to look like. So interesting article coming through here. I think that they nailed it. Yes, a lot of people are like, God, this is going to create more work. But at the end of the day, this lawsuit is not about protecting us. It's about protecting the public. And a jury of our peers said that we were guilty and of antitrust. And at this point, we don't need to be looking for ways to skirt around the rules, because it's going to open us up to more scrutiny, as well as the DOJ and any class action lawsuits can come after us as individuals. And so that's where we want to be careful. But let's jump into this. So this is what's important, right? So this is why we're all here today. Let's talk about the market. And this article came out on the 18th, so a couple days back, and it says mortgage applications to purchase new homes fall 16% in June. All right, so this is new homes. This isn't resales. All right, so this is truly the new home market. We're not talking about relisted homes on the MLS, second owner, third owner, whatever. And so it says mortgage applications to purchase new homes fell 16% month over month in June, but they've risen 0.7% year over year. All right, so we're less than 1% up year over year. And so that'd be June to June. Yet we're down 16% from the previous month. And when we're looking at this thing, it says by loan time, conventional mortgages continue to comprise of the majority of home applications for new homes. And guys, so that's very real as well. Like, when you're looking at this thing, conventional loans are number one, and VA and FHA and cash are pretty low after that. Like, that's kind of like the spectrum of loan products. Conventional, bigger one, FHA, VA, very small. I think it's like 25% is what your FHA and your VA loans look like. But if we're going through and we're looking at this thing, yeah, there you go. Accounted for 10% is VA. So if we're looking at this thing at 26% for FHA, there's the numbers. This is what we need to keep in mind with this. With applications falling, what we're going to see is less new builds being built. And it's not necessarily that there's going to be less new builds being built, but the rate of production is going to go down. And the rate of production is going to go down to where, like, if we were to think about this as like um, spec homes, all right? And so when we go through and the builders, what they're going to do is they're going to build to order, all right? So, and we pretty much see this in Colorado already, right? Like we go in and we see these projects just taking forever, right? They break ground on a community, and then like a couple houses start popping up, and none of them are ever really for sale, minus maybe a couple of lots. Well, we'll probably start seeing that slow down more and more as these application data goes down for them because they're not the March of Dimes. They're a for-profit company and they don't want to be caught holding the bag. All right. So what we're going to see is less of these quote unquote spec homes where they build a house and they're looking for a buyer. It's going to be here, give us your money, and that's going to reserve your spot. And then we're going to put you in the queue. And then we'll take you to the design center and then we'll start building the home and we'll see you in about a year from now, right? Like that's where this is going. So as these things are happening, this is what also less homes being built to spec, which again is going to turn into more. It's going to be a reserve your right, and then we're going to build you your home. What that's going to do is that's probably going to put a little bit more constraints on the market when interest rates go down, because that's the thing, interest rates have to go down. And we'll look at Optimal Blue and we'll see that they are going down. Like for the month of July, interest rates have gone down. And it's not anything like huge. I think that it says that it's like something around like 7% is what most rates are in July this year. But what's going to be very interesting is there's a lot of smart people out there saying that actually next month we'll probably see a drop in the rates. We don't know what that looks like, and we don't want to guarantee anything, but we need to keep our finger on the pulse around this because, again, there's probably some people that are waiting on the sideline that are saying, hey, when interest rates do drop a little bit, we are a buyer. And again, we don't know how quickly they're going to drop. It's probably not going to be anything exorbitant. But again, we do know that we're going to get some hands raised at that point saying, you know what, hey, you know what, it actually makes a little bit more sense now. And I'm ready to start looking. So we need to be making sure that we're having conversations. But this is very interesting. Like as we're looking at this thing, we're seeing less people raise their hand to buy new builds. And keep in mind, they're able to give better rates, right? Like while most people are on a resale or locked in around 7%, these guys are able to do some stuff, right? They're financing their own deals. So when they're having troubles selling a product that they are able to give better terms to, we should be thinking like, what does this look like? And again, what this is going to be is this going to be less inventory hitting the market. Not that they were a huge segment, but they have been doing very well and comparatively to what they've been doing in the past, just because of the incentives that they've been able to offer that a resale can't. So let's look at this. Let's look at national data. This is from Friday of last week. So this is rear view facing data. It says new listings have peaked for 2024. And this is the second lowest year on record. Like, guys, you are living through arguably one of the second hardest real estate markets ever. Because this is the thing, like when we were talking about the crash and people losing their houses, there were still people looking at opportunity, right? They were like, cool, like I can actually go buy some houses. I can start doing some flips. I can start doing some rentals. Like this isn't that market. So while we think about like the housing crash, people losing their jobs, like yes, that's awful. We don't ever like that's the most un-American thing that we can do is be like cheering for people to lose their houses and lose for their jobs. Like we don't want that. But in the grand scheme of things, like this market has been way harder than that because we have an affordability issue. We have some of the highest home prices we've ever had, as well as the highest recent interest rates that we have had since what, like the 80s. And it has put a lot of constraint on the market. So when we're looking at this thing, it says one of the critical forecasts for 2024 was the growth of new listing data and active inventory, even with higher mortgage rates. So even with interest rates going as high as they are for the price point of homes that we have, we were hoping to see more inventory hit the market. Because guys, this is a domino effect. And really, like, believe me when I tell you, interest rates have to go down. We don't know how quickly it's going to happen. We can't tell you when it's going to happen. We don't know at the amount that they're going to be taking these cuts, but it's going to happen. And while this won't look like 2021 as extreme as it was with the interest rates as low as they were, what will happen though with this constraint on inventory that we have, when interest rates do start going down, we will see some kind of bidding war. Like that's very real. Like we will see people when interest rates get to a point where people are comfortable going out and actually doing things. If the interest or if the inventory stays as low as it is, there's going to be high competition on the homes that are highly sought after in these neighborhoods. And so like we have to keep that in mind. That's going to push prices back up. Like that's why this is not 2008. That's why this is not where we're going to see this bubble, this crash, this whatever. Like this is a market where we have high interest rates. Home values are still holding pretty strong. Yes, they're coming down a little bit, but they're still holding pretty strong. And if interest rates start coming down, these prices will go up. Like it is inevitable. And so we just need to make sure that we're watching the market, we're having conversations, and we know what the wish list for our people is for when this interest rates get down to a point where they're comfortable, we're moving before everybody else starts hitting. So we look at this thing, new listing data, right? It says, I'm pleased that we see new listing data grow year over year, right? So when we talk about this as the second worst year, last year was the worst year, right? Like as we're looking at this. And we wanted to see around 80,000 to 110,000 homes in this range. But if we look at this, here it is. It says new listings for last week, 68,000. So that's 2024. 2023 was 61,000. 2022 was 73,000 homes. And here's your visual representation, right? Like we're right in between. And we know that seasonality, we're going to see less inventory. And while seasonality plays a little bit different since post-pandemic, as we're looking at this, we know that it's going to go down. People are going back into school. They're hibernating. We got holidays. We got all kinds of stuff about to happen. So historically speaking, inventory just goes down from here. And since we're in the middle, if we were to look at this historically speaking, we'll probably fall kind of maybe right in line with this, if not maybe a little bit less. Then we look at inventory data, right? So if we look at this weekly inventory change for last week, we grew 668 to 677. So we went up. Awesome. Same time last year. So same time last year, we were at 480 and went up to 485. Now, good news is this doesn't look like 2022, right? 2022 inventory issue, 240,000 homes. Only 240,000 homes were for inventory sake. And if we were to go and look at this, we're well above that. We're almost 3 times higher than this, which is a good thing. But keep in mind, like if we look at the very last one, 2015, there was less buyers, right? Way less buyers, way less of a population than we currently have in the United States right now, because we're talking what, 9 years ago, 1.2 million homes. All right. So we are about half that level right now with way more population. And I get that interest rates are high, but they can't stay this high. They will not stay this high. This is bad for the economy. All right. High interest rates are bad for the economy. And so as we're looking at this, at some point we got to break the dam. I don't know how quickly they're gonna chisel away at it, right? We've all thought that they were going to drop it quicker, but they haven't. But they will at some point. And with less inventory than the population and the demand that we have, when interest rates go down, this is what's going to keep our prices inflated, if not push them. So here we go again. Here's your visual representation. Here we are, 2024. We're kind of just in the middle, right? Pre-pandemic, this is what we consider a healthier market, a more normal market as far as inventory goes. Post-pandemic, all right, we're right in the middle right now. We want to see this line get up here. This is way better. This is a more balanced market. where yes, there's demand, but we're not giving away all of our contingencies to be able to get a house, which also helps inflation at that point as well, right? This is why we also have an inflationary problem when it comes to housing, which we have been curving with the interest rates being what they are. Price cut percentages. Guys, this is what gets weird, right? We're at 39%. 39%, and we know historical average, we said at 33. So 33% is what we have seen in the past for a yearly price cut. We're sitting at almost 40%, which that number has gone down a little bit. I think last time we talked, it was 40 something percent. So 39%, which, you know, okay, yeah, we're high. We're a little high. Currently 39%. Here we are. Here's 2022, 2023 as we get into the later months, right? Later months. And this is typically when we see it. We don't typically see price cuts in our selling season. And that's what's weird about this is that we're putting homes on the market. We're obviously not doing the CMA right, or we're letting the sellers pick the driver's seat and say, this is what I want to list it for. And then the motivated sellers are raising their hand and they're saying, well, you know what? I actually have to sell. So what do we need to do? And we're seeing 40% of all homes on the market right now take that price cut to sell their house. And yet homes are still sitting. So this is one of the most important things that we can do as we're sitting down at the dining room table and we're having these discussions with our sellers is to figure out what their motivation is, figure out how quickly they need to sell their home, figure out like what it means to them if they don't get their home sold in the time frame that they wanted to get their home sold or needed to, and just let them know that 40% of homes are all taking price cuts right now. So your competition's out there and we need to get priced lower than the competition. So we get more eyes on it and get your home sold to get you to that new stage of life is the reason why you called me today. Pending home sales are going up, which, you know, that's a good thing. We do want to see this. We want to see pending home sales up. And here you are, we're right kind of in the middle. So we're in between 2023 and 2022 data. We do want to see this get a little bit higher, but again, at the same time, we want to see more inventory. Purchase application data, we talked about this, but purchase application data has been slow to respond to lower mortgage rates. And again, guys, like we have lower mortgage rates today than we did a week ago, than we did 2 weeks ago. And it says, but 4 out of the last 7 weeks have been positive. And as crazy as this sounds, that's the best 7-week period for 2024 so far. So 4 out of 7 positive prints. That is a win, right? And we're in the basement, right? Like we look at this, here we are right here. Like there's the basement, this dotted line. Here's the basement. We're in the basement. And so we're in the basement right here, and we want to see purchase application data go up, but that's just consumers feeling comfortable with the price point that they're at and the mortgage rate for that monthly payment that they're going to be doing. So we want this to go higher. And again, seasonality gets kind of weird with the market that we're in. And again, I think that a lot of people are just on the sidelines waiting for the right house. They're not settling. And like as we were to look at this thing, if we were to look at like relisted homes, I think we're going to see that number be a little bit higher as well. Like they go under contract, they fall out of contract because the people are saying, well, you know what, at this monthly price point that I am hitting, this monthly dollar amount that's going to be coming out of my paycheck, I expect these things for my home, and they're not settling as much as they were, especially in 2021, where it's just like, I just need a house. We don't have the demographic anymore. That's not the mentality. So we're not going to talk about the 10-year yield. We're not going to talk about the spreads, right? We're not going to do any of that. But this is what they're looking for this week. And so it's prime time this week for the economic data and the Fed meeting. What else can you ask for when the 10-year yield is at a key 4.2% level? That's just his factor where he wants it to be. We not only have jobs week and the Fed meeting, we have home price data, pending home sales data from key Fed wage trackers known as the Employment Cost Index. So there's a lot of things that if they move in the right direction, guys, we may see interest rates go down. All right. And so like this is what's going on. And so we've seen inflation get curbed. We have like that's done. That's come and gone. Inflation data is on track. They're looking at employment data right now. And it's not necessarily like do less people have jobs, because they do. All right. So first and foremost, there are less job opening, or there's more job openings right now, which is what we want to see as far as like what the Fed wants to see. What they're looking at right now, though, as well is are people leaving jobs for pay increases because they also don't want that, which is super unfortunate. They're like, the Fed that we have right now says, not only do we want people to not have jobs, but we also don't want to see people leaving their jobs to go get paid more. Like that's very real. That's what we're in right now. So that's what they're going to be looking at when they're looking at jobs week. They're actually looking to see like how many people went out and got better paying jobs. Like that actually plays into their decision making, as sick as that is, because in my mind, that's disgusting, right? Like they're going through and they're saying, not only do we want to see more people not have jobs, but we also don't want people leaving their current job to go get paid more because that's bad for the economy, right? That's truly the mindset of the people that we're dealing with right now. So that's some of the information that they're going to be looking at to make the decision whether it's time or not to lower rates. So rates, we're talking about rates. Here we are, guys. Like we started July, this is July 1, and a conforming loan was 699 and FHA was 746. So we were to fast forward to yesterday because this is as updated as it is. 6.7 for conforming and 6.5 for FHA. It's going down. All right. And this is some of the things that we kind of hear Mitch talk about in the meeting is like, well, we don't need the Fed to lower rates for mortgage rates to go down, right? Like he says that. And it's very true because it's just a spread. There's a yield that they're trying to get where they want to be able to make money on their money and they want to be comfortable about lending money. But it does make things easier when the cost of money gets lower to these banks because then they're willing to lower their rate back to us, the consumer. And so we're seeing it get down. And so we just need to be cognizant of this because as we're going through, again, the rates are going to continue to go down. I'm not saying there won't be maybe a spike somewhere, right? Like I can't predict if there's going to be a spike, but my crystal ball, like if you guys were like, Charles, let's bet on this. Like I feel comfortable saying that like rates will go down at least one time this year. Like I know that we're in August almost like in 2 days from now. Um, but rates are going to go down. I feel like next month is a very, very likely probability that we're actually going to see a rate cut. And it's going to be dependent on what they see in the next couple of days when they're going through this data. But everything else is being checked at this point. Really, all they're looking for is they went through and they said, have we curbed inflation? Yes, we have curbed inflation. It's not exactly where we want it to be, but it's pretty dang close. We've gone through and they wanted a job. They wanted people to lose their jobs. People have lost their jobs. There's plenty of jobs out there right now. There's people that have lost their jobs. Now, the third thing that they're looking at right now is did the people that traded jobs, are they making more money? If they're not making more money, then we're probably going to hit all the key terms that they're looking for, and we're going to see a rate cut. But this is interesting. Like as we're looking through it, is going down. We just have to figure out what's important to our consumer. And then let's look at Alto's data, right? Like this is important information. So median list price in Arvada has gone up a little bit, $744,000. All right. So the median list price point in Arvada, Colorado, $744,000. The median list price of new homes, 718. All right. So new homes hitting the market, $718,000. This is lower than the homes that are currently on at 744. So again, like this is the right pricing strategy. Like as we're going through and we're talking to our sellers and we're talking about the competition isn't what my neighbors sold their home for 2 years ago. It's what homes are sitting currently on the MLS in your neighborhood, and we need to get underneath them because we need to price ourselves strategically. So we're seeing this at almost 20, right? We're talking north of 20, what, $4,000 difference here. Price per square footage has gone down and kind of flattened out to 279. Average days on market, 56. So again, average days on market, they're taking all the numbers, all the days on market, they're dividing it by the total, and they're getting the number 56. But then you look at this median, the median's 39, right? They're taking all the outliers and they're working down into the middle. And that middle number is 39. So 39 tells me these are the people, right? We're having the conversation. It says, hey, Mr. and Mrs. Seller, if we price your home right and we're getting lower than the competition, which is the homes in your neighborhood that look like yours, we'll be closer to the 40-day mark, like, right? Like a month and a week versus almost a 2-month mark. You told me that it was important to get your home sold by this date so that you can start your life here. And do you want to be able to get that done? This is what we need to do, right? We need to be that real estate economist of choice and walk through that. Price decreases. All right, 52%. 52% of all homes in Arvada have a price decrease on them, right? We just looked at this thing, right? If we were to go back, we were to scroll up here, we're talking about national data. National 39%, all homes take a price cut. We're at 52% in Arvada. That tells me that we're pricing homes way too high. Like we're letting emotions probably drive this, and some data that we found on Zillow that we didn't scrub a little bit better, right? Or like what we heard from the neighborhood. Guys, as we're going through all this commission lawsuit and everything and talking about our value proposition, and we know that we're going to have a lot harder of conversations. And when I say that, I really just mean like people back in 2021, they could fog a mirror, they can get a mortgage application, interest rates were cheap. You walk into a bar, you raise your hand, I'm a real estate agent, people were interested in buying. Well, now we have to know what our value proposition, and we're going to have to be able to read some numbers and know what's going on and be able to have a conversation with these people. And so 52%, that's high. And so 52% of all homes are just sitting on the market taking price decreases in Arvada specifically. We need to be able to educate. 4% price increase. And so here we are, it did flatten out a little bit. And again, this is new homes. And we just talked about this. Like if they're not selling new homes, they're not putting phase two, phase three, phase four on the market. It's going to be more less specs and more builds, right? So you reserve your home, you reserve your lot, we're going to start building it, see you in 12 months. So this number I expect is going to probably sit at 4, maybe drop down to like 2. Like I don't think this is going to spike anytime soon. Realist, we talked about this, 7%. This is going up. The price point where we're sitting at with the interest rates of where we're at, we're going to see more discerning buyers walking away from deals that don't make sense. And so we need to be able to find solutions for both parties, figure out what the motivations are, and help them get past the finish line. Inventory 284, monthly rent has gone up. It's at $3,100. $3,100 per month gets you a home in Arvada to rent, which just seems astronomical to me right now, $3,100. And then market action. So we're at a 50. And guys, that market action, you can see it right here. This is what they base it off of. They say we're still in a seller's market. We're this red line right here. We're sitting in this 50. It's a little bit worse than what it was last month, based off of their key factors that are sitting in here. So as we're looking at this, guys, again, commission lawsuits, we just have to make sure that we know what's going on, and we just know that we don't put ourselves in some situation where we're going to get hit with a lawsuit because we violated some settlement agreements. It is interesting to see this, that purchase application data is going down with new homes are concerned, because again, they have the ability to go way cheaper than a traditional lender on their products. And so if they're having trouble selling new homes, that's no reason why this doesn't make sense, right? Like as we're looking at this thing, we're seeing them get relisted, we're seeing price cuts happening, because these guys that actually have the purchase ability to make different things happen with their purchase mortgage products, if they're having a hard time selling at lower rates, of course we are. Going through again, just looking at it, inventory is going to cure a lot of things. We need to see more inventory, but again, if interest rates go down and inventory doesn't go up, we're going to see prices start going up as well, especially with these guys slowing down, nothing happening on the market, higher prices going up. And we just have to watch this, and this should be part of our daily routine. We need to be knowing what interest rates are doing, because they are going down and no one's really talking about it. And while it's not astronomical, it's moving, guys. I mean, again, 7% down to 6.7. And while it's not a 100 basis point swing, it is 30. We've seen a 30 basis point decrease. And so being very cognizant of that, because when we do hit another 70 basis points, how many of your people decide to be a buyer at a 6% interest rate? I bet it's but it's a lot of hands that actually start going up. So we just need to make sure that we're having the conversations and we know who those people are.